Hook. I analyzed a Bitcoin Treasury company last quarter trading at 4.2x mNAV. On the surface, it looked clean. BTC holdings, 2,400 coins. Equity raise, fully diluted, no near-term converts. Ticker momentum, up 180% in 90 days. I almost bought in. Then I pulled one number, their debt to BTC ratio, and the whole story changed. That single metric told me this wasn't a Bitcoin accumulation vehicle. It was a leveraged bet with a ticking clock attached to it. And that's exactly the problem with how most people approach Bitcoin treasury stocks right now. They look at the BTC number, they look at the stock price, and they stop there. They never ask, what am I actually paying for? And more importantly, is the premium I'm paying justified by anything real? By the end of this video, you'll have a three-factor framework that lets you evaluate any Bitcoin treasury company's mNAV premium in under 5 minutes. I'm going to run it live on 5 actual companies, Metaplanet, Semler Scientific, and 3 newer entrants that have been getting a lot of attention. Stay with me. This is going to be the most useful 9 minutes you spend today. Section 1. What mNAV actually measures and where it breaks down. Let's start with the math because mNAV gets misused constantly. mNAV stands for multiple of net asset value. The calculation is straightforward. You take the company's market cap, divide it by the current dollar value of their Bitcoin holdings, and you get the multiple. A company with a $500 million market cap holding 5,000 BTC, let's call Bitcoin $95,000, is sitting on $475 million in BTC value. Market cap divided by BTC value, roughly 1.05x mNAV, nearly at par. That sounds cheap. But here's where people get confused. mNAV doesn't account for debt. If that same company has $200 million in convertible notes outstanding, your real exposure isn't $475 million in BTC, it's $475 million minus the $200 million they owe, which is $275 million. Suddenly, your effective mNAV isn't 1.05x. It's closer to 1.8x. You've just paid 80% more than Bitcoin's spot price for exposure you thought was nearly at par. This is the core mistake. mNAV, as typically reported, is a gross multiple. What you actually want is a net multiple. Market cap divided by BTC value minus total debt obligations. The difference between those two numbers is where real risk lives. Now, some premium is rational. A company with a proven track record of BTC per share accretion, a clean capital structure, and institutional-grade access to debt markets should trade above par. The question is always, how much premium and what am I getting for it? Section 2. Metaplanet versus Semler. The real comparison. Let's get specific. As of early July 2026, Metaplanet holds approximately 13,350 BTC at $95,000 per coin. That's roughly $1.27 billion in gross BTC value. Their market cap has been hovering around $3.1 billion, gross mNAV, approximately 2.4x. But Metaplanet carries Japanese yen-denominated bond debt, roughly $400 million equivalent. Strip that out and your net mNAV is closer to 3.6x. You're paying 3.6 times the underlying Bitcoin value on a net basis. Is that justified? Here's where the nuance matters. Metaplanet has been one of the most aggressive BTC per share accretors in the space. They've issued equity and bonds in ways that have consistently grown BTC per diluted share, not just total BTC. That accretion track record is real, it's documented, and it does justify some premium. But 3.6x net is aggressive. You're pricing in years of continued perfect execution. Now compare Semler Scientific. Semler holds approximately 4,700 BTC as of this month. Market cap, roughly $820 million. Gross mNAV, about 1.85x. Semler has virtually no Bitcoin-specific debt. They have some legacy operating liabilities, but their BTC exposure is largely unlevered. Net mNAV, close to 2x, significantly cleaner. Here's the interesting trade-off. Semler has an operating business, medical technology, which creates a revenue floor but also creates noise in the P&L. Their BTC strategy is real, but it's not a pure play. Some investors discount that, others see it as a hedge. Either way, at 2x net mNAV, you're paying a much smaller premium for a much cleaner balance sheet. The takeaway from this comparison, Metaplanet's premium is partially earned, but the margin for error at 3.6x net is extremely thin. Semler's premium is modest and the structure is cleaner,